Pensions can be confusing and boring at the best of times, and let's be honest, you probably haven't given much thought as to what actually happens to your pension when you die. Before your eyes glaze over, stay with me, as your pension is likely to be one of your biggest assets, and it may even be worth more than your home, and in the majority of cases, your loved ones can benefit from it in some way after you've gone. I'll give you some examples throughout the video of what would happen on death with various pensions so you can relate it to your own circumstances. For defined contribution pensions, the answer really depends on the age at which you die. Let's use Harvey Headbanger as an example. After a lifetime of sex, drugs and rock and roll, he passes away at age 68 and has 200k remaining in his pension at the time of his death. His pension supports beneficiary drawdown, and he's previously completed an expression of wish for his daughter, Kelly, to receive the pension even when he snuffs it. As Harvey died before age 75, Kelly is entitled to receive the pension completely tax-free. If we assume this, of course, she was designated the funds within 2 years of Harvey's death. As the pension Harvey had supports drawdown and beneficiary drawdown, this means Kelly can take the whole 200k as a lump sum tax-free, or she could even take smaller tax-free lump sums as a regular income and potentially benefit from any investment growth. The options available to Kelly and also your own beneficiaries with your own pension will depend on your particular pension scheme's rules. Many older legacy pension schemes or workplace pensions don't offer drawdown, so you should be aware of this. In such cases, beneficiaries may be limited to taking the remaining pension as a lump sum, which could be paid to the estate, or it could be converted to a guaranteed income in the form of an annuity. Now, what happens if Harvey had died after age 75? Kelly would again been able to inherit the pension, but any withdrawals would be taxable at her marginal rate of income tax. So, if she was a basic rate taxpayer and she had taken a 10k withdrawal, she would be left with £8,000 after £2,000 would be deducted for income tax. It's very, very important to complete an expression of wish. The trustees of your pension scheme then have discretion on who to give the benefits to, but they're going to usually follow your wishes. This discretion is very, very important, as pensions in most cases will not form part of your estate for the purposes of inheritance tax. In Harvey Headbanger's case, he was a very successful rock musician and left behind an estate worth well over £3 million. As he had completed an expression of wish, his pension will not be included in his assets for the purposes of calculating the inheritance tax due. This is why we'll often see clients who may have sizable estates and assets run down their other assets such as ISAs, cash, money in the bank, whilst leaving the pensions intact to act as a bequest for their children or whoever they like. However, if both the tax-free nature before death at age 75 and also the inheritance tax position sounds too good to be true, that's because it may be. At the time of recording this video in October 23, there's rumours circulating the Treasury may scrap the inheritance tax position of pensions in the age 75 rule as a quid pro quo, really, for the abolishment of the lifetime allowance that was announced earlier this tax year. If you don't have an expression of wish completed, things can get a bit more confusing. Your pension trustees may just pay the proceeds out of their discretion, or they could just do this if your pension scheme stipulates it will just be a lump sum paid to the estate. If it is paid to your estate, well, in which case the funds would form part of your estate and would be assessed against inheritance tax along with your home and any other assets that you may have. That's why it's always very good practice to complete and update your expression of wish, and even have alternative beneficiaries named in case quite morbid your primary beneficiaries predecease you. It's at this point, though, we do need to insert a caveat. Although pensions typically will be free of inheritance tax, in the vast majority of cases, it will depend on your pension scheme. Some older pension schemes may just pay out the lump sum on death to your estate, as we mentioned earlier, such as Section 32 buyout plans, retirement annuity contracts, and a small number of occupational pension schemes or hybrid DC-DB pension schemes, and they would be assessed against your IHT in that scenario. If you're in poor health, transfer a pension and die within 2 years, then the pension may be subject to inheritance tax. With regards to ensuring your loved ones can receive your defined contribution pension after you've gone, and to check what death benefits you're entitled to or they're entitled to, you can carry out some simple steps. Ask your pension scheme to clarify what the death benefits are, find out if beneficiary drawdown is available, and finally complete and regularly update your expression of wish. If you found this useful and Harvey Headbanger's situation has put your position and pension into perspective, then please like and subscribe to the channel before we look at DB pensions. For those of you who aren't aware, a DB defined benefit pension is a promise to pay you an income. You're not going to have an individual fund as such. You'll accrue benefits based on your length of service and your earnings, which these days is more commonly your career average earning. Defined benefit pensions are typically public sector schemes such as the NHS and police, and uniform services in general, but some companies also operate DB pension schemes still. If you have a DB pension, then the situation is slightly different, and what you get will depend on the scheme's rules and also your own circumstances. So a quick recap on DB pensions. If you're still employed by the sponsoring employer of the DB scheme, then you're known as an active member. If, on the other hand, you've left the employer who provided the DB scheme, then you're known as a deferred member. You'll often hear this referred to as a frozen pension, although this is not strictly true, as your benefits that you've built up will still increase, which is usually by a form of inflation. If you unfortunately pass away after you've retired and are drawing your DB pension, then your scheme typically will pay a dependent pension. This is a regular income expressed as a percentage of the regular income at the date of your death. 50% is quite common, but it can be more or less than this and even be a monetary amount in some rare cases. Let's see an example. So Claire retired to the Cotswolds to enjoy her retirement and took her DB pension. And this pays her an index-linked pension, which is basically a fancy word for a pension that's linked to a form of inflation that will rise, such as RPI or CPI. Her pension pays her 20k a year and it has a spouse pension of 50% attached to it if she dies. She's married to Phil and at age 70, she unfortunately passes away. Under this example, Phil is entitled to half of the pension at the date of Claire's death. In this example, it's going to be a pension of £10,000 a year. Once Phil passes away, the pension usually dies with him. Unlike a DC pension in the example of Harvey Headbanger earlier, even if you die before age 75, a DB dependent pension will be treated as earned income for the recipient. Your pension scheme administrator would just deduct any income tax due under pay as you earn. Now, what would happen if Claire was divorced and her children were grown up? Well, in this case, it's likely that the pension would die with her. DB pensions can also have a minimum guarantee period so that even if you die, the scheme will continue to pay out the full pension for a certain period of time, which could be 5 years or 10 years, something like that. Now, what about if you die before drawing your DB pension and you're not even getting an income from it? Well, it's possible to get a lump sum payment if you die, but this is usually only reserved for current employees who, if you remember, are active members of the scheme. This is typically a multiple of your salary, such as 4 times, but I've seen more and I've seen less than this. If it's from a death in service policy, which it usually is, then before age 75, this is tax-free. In the very unlikely event you're still working after age 75, then the whole payment will be taxable at the beneficiary's rate of income tax. In addition to the lump sum, there'll also be the dependent pension in the form of that regular income that we looked at earlier. Now, this dependent pension is for anyone who's dependent on the deceased scheme member at the time of their death. The classification will depend from scheme to scheme, but usually it covers a surviving spouse, civil partner, children under the age of 23, children in full-time education, or anyone who may be deemed, in the opinion of the trustees, to be dependent on the member at the time of their death. So you may be wondering, if you aren't married, but you live with your partner, you split the bills, would you be covered? Again, it's going to depend from scheme to scheme, but usually this clause would. If you have both a surviving spouse and dependent children, then usually they're just going to pay the pension to the spouse. It's worth noting that a spouse-dependent pension could stop if you remarry, just as a dependent child's pension would cease when they're no longer deemed to be dependent or reach a certain age. If you have an annuity that is in payment, it's going to depend on the options that you choose from the outset. With annuities, you can usually set it up based on a single life basis or choose an annuity which has some form of guarantee built in, such as a survivor's pension, which is Like a DB pension, usually a percentage of the pension you get. 50% is quite common, but you can go up to as high as 100%. It's also possible to add a guarantee that will ensure the annuity is paid for at least a certain number of years at the full amount, and then it can revert to the survivor's pension if there is one. The guarantees with annuities, though, do come at a cost, however, as the amount of income that you get will be less than a comparable annuity that is set up on a single life basis. It's all good and well knowing what happens to your pension if you die and trying to maybe help your loved ones out after you've gone, but it's useless really if you have no idea what kind of income you can expect to receive from your pension and what the numbers could look like. So have a look at this next video, which looks into this.